All right, welcome back to this week's edition of the Tech Corner. I'm Senior Markets Contributor here with the Schwab Network, George Tsilis. Thanks for being back with us. This week, we're going to be evaluating Netflix Incorporated. Now, Netflix is a global entertainment service provider offering a vast array of TV series, documentaries, feature films, and games across various genres. As a video-on-demand distributor of movies and television shows over the internet worldwide, subscribers have access to the Netflix content library for a fixed monthly subscription fee. The company also offers various service tiers, including a discount as well as advertising-supported tiers. This flexibility allows Netflix to cater to various consumer needs. The company is also renowned for its ability to stream content across a multitude of internet-connected devices, such as TVs, digital video players, set-top boxes, and mobile devices. The company maintains its strong commitment to improving its user interface and content offerings continually. It also engages in producing original content in numerous countries, which supports local economies and cultures. A few data points to highlight is that the company has actually grown to serve over 302 million paid subscribers in 190 countries. It also derives about 59% of its total revenues outside the United States. Now, when it comes to the competitive landscape, Netflix operates in a very competitive streaming industry. Mainstay competitors include Disney, which owns Disney Plus and Hulu, Amazon Prime Video, Warner Brothers, which owns HBO Max and Discovery, Paramount Global with its Paramount Plus platform, as well as Comcast and traditional linear TV with its Peacock and NBC business, and Alphabet, the parent company of Google, which owns YouTube. Now, all these competitors provide a similar streaming service, offering extensive libraries of movies, TV shows, and original content, often competing for the same audience. Now, with Netflix, the unique value proposition lies in its extensive global reach and its ability to produce culturally relevant content tailored to specific markets. Its proprietary technology enhances user experience through personalized recommendations, which is also a significant differentiator. Additionally, Netflix investment in artificial intelligence and data analytics enables it to optimize content curation and advertising, creating a defensible moat against competitors. Furthermore, the company's ad-supported subscription plan expands accessibility, provides a new revenue stream, reinforcing its position as a leader in the streaming industry. Now, from a financial highlight standpoint in recent news, the company reported earnings and sales on April 17th. From an earnings standpoint, the company reported $6.61 a share. It actually beat the estimates by 95 cents, highlighting an increase of 25% year over year compared to the same quarter last year at $5.28. Top-line sales came in very robust, up 12.5% year over year at $10.54 billion. Most importantly, and I think this also suggests why the stock has improved significantly since then, is operating income totaled $3.3 billion, up 27% year over year, and operating margin was 32% versus 28% as compared to the previous quarter, fiscal Q4 of 2024. Quarter over quarter, with a 400 basis point increase sequentially in operating margin, the company also posted a near 1,200 basis point increase compared to the same quarter last year. This demonstrates disciplined cost management, highlights the company's successful expansion, and robust financial performance. Now, there are many positives to consider with Netflix. First off, its AI-driven platform boosts engagement and production efficiency, outpacing traditional broadcasters and big tech rivals, with ad-supported tiers driving half of new signups in available markets. The launch of the successful ad-pay subscription plan is working. Advertising is a new revenue source, paid sharing rates are available in the US and expanding successfully to select countries. Netflix's leading distribution to subscribers around the globe is also attracting cross-licensing opportunities. The company also showcases remarkable growth metrics as well. Revenue growth was over 15% year over year when you actually sum up the last 4 quarters. This is substantially outpacing the sector increase of around 2%. It also, as a company, boasts superior profitability with a net income margin of 23%. This is significantly above its competitors with an average of 4% in the media space. This excellent profitability underscores the company's efficiency in converting sales into profits. Now, aside from the positives, there are also some concerns we have to highlight. First off, the company's valuation is quite high. It's trading around 48 times next year's earnings, which is above its 5-year average multiple of around 42 times. This makes it less attractive than other tech names in the media space, with key risks including intensifying competition and potential pitfalls in sports broadcasting. The company also recently removed subscription detail data and also is demonstrating some slight cooling revenue growth when it comes down to its United States and Canadian markets. This raises concerns about transparency as well as its growth outlook. From a macro-centric standpoint, potential tariffs on imported movies and content could significantly impact Netflix operating margins, reducing them from around 32% to potentially half in the forward 4 quarters. Now, from a technical analysis standpoint, Netflix exhibits exceptionally strong stock price momentum. With a one-year price performance of over 80%, this significantly is outperforming the S&P 500's gain of around 9%. The stock is also trading above both the 10 and 20-day moving averages, which suggests the near-term trend is positive and bullish. The stock is also trading above its rising 50-day moving average, which validates the strong technical condition for Netflix. Price action is also above the upward sloping 200-day moving average, which indicates that the intermediate term trend is still bullish as well. From a relative strength standpoint, the stock has outperformed the market over the last 30 and 60 days when compared to the S&P 500. The MACD indicator as well as the RSI indicator are also rising, confirming that the intermediate term trend is bullish with upside momentum. Now, in summary, we have to remember that Netflix's unmatched brand reputation and massive subscriber base, along with its innovative content offerings like live sports, make it a compelling media content leader. With a significant focus on proprietary technology and intellectual property, Netflix remains a prominent figure in the competitive industry landscape. The company is doubling down on a bold growth strategy. It's expanding beyond streaming with immersive ventures like Netflix House theme parks and linear TV to drive its revenue streams and deeper user engagement. Meanwhile, international content investment, global expansion, and technology innovations may continue fueling long-run subscriber growth and market share for Netflix. Well, that's all for this week's edition of the Tech Corner covering Netflix. Next week, we'll be covering technology giant Tesla after its robotaxi event coming up this weekend. Thanks for joining us once again. Please like and subscribe to the Schwab Network. I'm George Tsilis. See you next week.